Hi, everybody, and thank you for joining us for our October State of Freight webinar here at FreightWaves. My name is Kaylee Nix, and we are very excited to welcome you into this webinar where we will dive into some of the latest market insights and some of the most current events that are affecting the freight markets today. We're going to hand it right on over to our FreightWaves Head of Freight Market Intelligence, Zach Strickland, to get us started.
All right, thank you for that and welcome. Thank you for tuning in to this October Freight Market update here. I'm Zach Strickland here with Craig Fuller, our CEO. Now, I think we need to set the table first. We've had three huge freight market disruptive events, and we need to kind of get some context before we start talking about where we're going. So, Craig, tell us what your take is on these big three events that hit the freight market.
I think we have to separate the hurricanes from the port strike, because I think they're actually two different types of issues. One we knew was coming, which was the port strike. We knew that there was an inevitability. We didn't know if it was going to strike, but we certainly knew that this was an event that the market would react to. And then you had the hurricanes, which we anticipated, if you remember back in May, that NOAA sent out that forecast for the busiest hurricane season on record. And I think last time we got together, maybe a couple times ago, we talked about the fact that this hurricane season has actually been one of the least active in history, in the 1960s. And therefore, it wasn't actually driving or an impact in the freight market. That clearly has changed. We've had two very significant storms that have impacted. If you think about Helene went up to all the way to North Carolina. It's a place that we hadn't thought about. One thing to keep in mind, I think, just we know this, but perhaps our viewers don't know it as well, is that part of North Carolina isn't a big freight production, nor is it a big inbound spot.
Right.
With the exception of the only major city that was actually impacted were the cities in Florida, but it largely missed big population centers and big freight production centers. And then Asheville, North Carolina, and what we saw along Tennessee and North Carolina. Asheville, Greenville was impacted, some of those cities along that line. Asheville certainly has taken a pretty big beating. But in terms of freight and what that means for freight, those areas don't produce a lot of outbound activity.
Yeah, so I think the read here, we could pull up the Tinder rejection index too, to just kind of figure out where we are in terms of destabilization. So you're looking at the last year of Tinder rejection index. You can see looks pretty volatile, but it's actually pretty muted. Anything below about a 5-6% threshold we consider to be a relatively loose freight market environment. We can see some spikes here. And the overall trend line still appears to be in play, that since about May, we're seeing increasing tender rejection rates go up. If I pulled this out to 2 years, you would see the same trend versus May of 2022. Or 2023 here is where I'm talking about. May of 2023, that was the bottom, I think, as we have come to agree, of the freight cycle.
May of 2023 was the absolute bottom of the cycle.
And then now we fast forward all the way to the end of the chart here in October, and you can see this big spike. We jump up over 5%. I think we've kind of thought of 5% as this artificial boundary of where we see a breakout.
Well, I think again, and I've said this, is that the actual rejection rate is less relevant than the direction of the chart. It is about, are we seeing tightening conditions or loosening conditions? Right. That is what you're looking at when you look at the chart. And what we saw was an aggressive tightening, or at least compared to where we were prior to when these hurricanes hit, a tighter market.
Right.
And that's what the data is telling us. What is interesting about that is Helene definitely did far greater sort of economic, relative to the economy, its local economy, and more loss of human life than Milton did.
Right.
But the locations of where the hurricanes hit, the path actually has a lot to do with the freight significance. And one of the things to keep in mind is we have natural disasters unfortunately happen all the time. Now, modern society and civilization is built to really withstand most of those. But occasionally you do have these events that become pretty catastrophic.
Sure.
The reality is that what matters when we look at the freight market is an event needs to be so big and so significant to actually throw the freight market out of balance. And neither of these storms actually lived up to do that. So Milton is a much bigger storm in terms of its impact because of where it hit, But one of the things that was interesting about Milton is it didn't stay very long. Is it could have created an enormous amount of damage to the state of Florida. Its path was really in an incredibly, 10 million people were on that path. These are huge population centers. One of the, I think, real sort of saving graces for Florida is it moved so quickly through the state that while it did some level of damage, it didn't actually do that much. And one of the things that we've talked about this before, this as a sort of a jailhouse meteorologist, is that the flooding is actually what causes all the damage. I mean, the winds cause damage, but it's the flooding.
Winds get the headlines, the water gets the...
Especially in Florida, because the building codes in Florida are such so that they can withstand, we're talking windows and things like that. They do prepare those houses under modern building codes for winds. The flooding, there's not a ton that you can do about it if it comes in. And what really determines the flooding is a combination of the amount of water, but also the time that you flood.
Right.
And Milton didn't stay long enough. To do much damage.
I think it's interesting though that, Milton probably got the credit for a lot of the tender rejection rise that you see on the screen, but it's not necessarily the more damaging storm. And I think that's something that people have trouble recognizing. Like I got tender rejection rates for the Lakeland market going in and out. So I've got inbound and outbound tender rejection rates for Lakeland, which is Central Florida, pulled up on my screen at least, maybe eventually for yours. And inbound tender rejection rates spiked going into Florida. And they also spiked going out of Florida, but not to the extent of the inbound. Now, inbound, you and I both know, Florida is a black hole for a lot of carriers.
For outbound freight.
Yeah, you cannot find
except for produce.
Yeah, except for refrigerated, largely.
Yeah.
But you go in there, you basically have to deadhead coming back out. Inbound rejection rates still above 14%, but it looks like both of these indicators showing signs of coming back down. So this looks like, to me, on the heels of Helene, ILA strike, which really was a localized and very telegraphed event.
ILA strike could have been detrimental and catastrophic, but it also did not last long enough to have an impact on the market. 2 days of shutdown, maybe another day of sort of getting back to work is not in an economy the size of ours, and it just isn't significant.
There was a lot of mitigation before ILA.
A lot of mitigation. There was also a lot of back conversations. I think one thing that this administration should get some credit for that perhaps we don't give it credit is that a lot of that stuff was kept in secrecy.
Yeah.
Like a lot of the conversations with, if you think about politics, what the Biden administration has not done, and I think detrimentally in some ways, but also positively, is they're not as transparent about what is going behind the scenes than we've seen in the past in some administrations. And so in some ways we're having conversations at the back end, and none of that stuff was actually really being talked about publicly as to what they were doing. It looked as if they weren't doing much, but obviously we have a settlement that is frankly pretty significant.
Yeah, I think to me though, we kind of can push these situations. I think January 15th is going to be a date that we probably need to talk about at some point, but not yet. It's not going to matter.
That is the ILA, the contract has been
pushed.
And the issue,
has to be ratified.
They've gotten, at least verbally, have agreed to their salary increases. And I don't anticipate those being retraded or revoked. I mean, that would cause massive. So you assume that the pay increases are going in. Yeah. The question is, how big is automation? We've seen the public posturing by the ILA president about automation. We've seen the stuff leak. At the end of the day, I don't think that's going to be a factor, because I think ultimately the rank and file, which are going to vote on this this contract, actually care far more about their wallets and far more about their finances near term than they do about automation. Right. Because for them, I would much rather have the pay increase than I would worry about if automation is going to put potential future union members out of work. Do I really care at the end of the day about new members as much as I care about my own wallet? No. Like you don't. I mean, that's just
Right.
science. Like it's like looking at the election. Is people tend to vote with the
does
one or
this-
two like things they care about, and a lot of it's economics and a lot of it's taxes. Like that's why this is the silly season of every giveaway you can possibly. How are we going to keep track of all this stuff? By the way, like we have been promised so much this season.
Nobody really knows what's going on. Let's be clear. Like it is like there's so much verbalization, so many promises, so many things going on. It is impossible for
And
the
it's the
average
same.
person.
Going back to the point, it's the same thing with the union contract.
Yeah.
Is the union has a public stance, and I think maybe the threat of no automation, absolutely no under no terms, is the thing that they're able to signal, and maybe that's the thing that isn't becomes as firm.
Yeah, but I don't think you don't believe that this is going to be a big disruptive force.
I don't believe that the January 15th date has anything to do with the freight market. I think it's a non-event. I think the inventory cycle, the building cycle, really will benefit the trucking market. I think we do see a situation where importers brought in a lot of imports just in case to have excess inventory. They're going to start liquidating that stuff. If they believe that the strike is truly over with, then they now have the opportunity to liquidate some of these goods. Now, one thing we need to talk about is the election. And like this isn't a political show. We're not political commentators. But if you think about the significance of the political cycle and the freight market, hurricanes themselves do have impacts if they're big and massive enough. These strikes do have big impacts, but they're always sort of on the peripheral of could have an impact, but it takes something so big. The one thing we absolutely know without a doubt and have so much historical data is that government policy, particularly when it's economic policy, can have a massive impact on the direction of the freight market. That is fact. And you can go back through every single major economic policy change, whether it was stimulus, tax changes, you've seen contraction in a monetary or a change in monetary policy. Anytime you see that, it has an impact on freight because the U.S. government is the most powerful global entity in the economy. And when it changes policy, it impacts everything around it. And that is something that is really important. And politically, what happens in this White House is going to matter a lot. I think much more so than it has in the past, because you have such a polarized direction in terms of two sort of extremes in terms of how people are viewing things, that it's definitely going to have a tremendous impact.
So, I mean, we've been in, you and I look at the data all the time. We can tell that the demand cycle that we're in is actually not muted. I think a lot of transportation providers would debate that with us because they feel like demand is down, but it's because that demand is being dispersed.
Well, there's so much capacity in the market. Like
Over
demand is not,
Yeah.
at the end of the day, everyone cares about their own demand. They look at, I don't have enough business, the economy must be in a slump. And that's an easy thing to draw from because that's how people sort of feel about it. It's the old adage that, I think it was a Dan Quayle quote about the recession. If your neighbor loses their job, it's a recession. If you lose your job, it's a depression.
Right.
It's the same thing.
Right.
Like, it's all about relative experience. This is the reason when we talk about market directions, I get a lot of heat, whether we're bullish or bearish, because people are looking at their own experience and saying, this is what it looks like on the ground. I think those anecdotes are important. I think those reports are important. But what is actually important is to look at the data and understand that this market is all capacity constrained. And what we need to look at is a combination of volume and capacity. We talk about this every time.
Yeah.
So, but it has been a pretty
if we
strong market. I mean, you've got IOTI pulled up.
Yeah, let's pull up the import bookings, the IOTI here, that shows that we're on par or close to on par with COVID level import levels.
That has been, like, 2 years ago, I'll say one of the things we got absolutely wrong was we argued, and I certainly argue this, that record imports, we've seen record imports, we'll never see the level of imports that we've seen. Clearly that was wrong.
Right.
The question has been, what has been driving that? So we know the port strike threat has been there. I think that was a factor. I don't think it's as big as perhaps some have argued.
Right.
I think there's something else in the data that's happening. And what I've sort of argued is that tariff threats are real. The belief is that regardless of who ends up in office, that tariffs are going to happen. We're going to see an acceleration. We've talked about this before. The Biden administration has not reversed a single one of Donald Trump's tariffs. In fact, they've doubled down on certain types of tariffs. I think one of the interesting things is the Biden administration is a bit more targeted, a bit more sort of followed a playbook that most administrations have, which I'm going to protect the steel industry, or going to protect, in their case, going to protect the EV industry and the battery industry. The Trump administration's much more like, hey, we're taking it all out. We're going to target these countries. I think we end up seeing that. I think that's the stance, and I think we actually see something. I think it will be a negotiation tactic. We'll see it not be as
Tariffs are
draconian.
Legitimately negotiating.
They are, by definition. They're intended to, like, we're not talking about cutting off, basically embargoing countries. We're talking about, tariffs were originally meant for really two purposes. One is for taxation. It's how the United States made all of its money as a government. We didn't have income taxes. It's great. We dealt with tariffs. Tariffs are like foundational to the taxation system. That's how we paid for government services. It was only when we shifted into an income tax regime and other taxes to pay for all of our wars that we ended up changing tax policy where it became income taxes. That was in the world of history, that was a relatively recent thing in the United States. And so the reality of it is that the tariffs are intended to do two things. One is it's intended to raise money for the government. That isn't a huge source of funds today relative to our budget, not to the degree other taxes are. The second thing it's intended to do is encourage manufacturing, create a competitive playing field for domestic manufacturers or domestic producers, and cut off essentially, or make foreign goods more expensive than you are for that, and to essentially make sure that if products are produced cheaper, that they don't benefit from that sort of arbitrage. That's what they're intended to do. Donald Trump has argued 60% tariffs on Chinese goods. It's playing the data. That's a huge issue. The other issue, we've talked about it, is that the Chinese domestic economy is reeling from one of its biggest downturns because Xi has sapped confidence. Businesses are not making investments. We did see a change in Chinese policy in the last 2 weeks. I don't know if you saw this.
No.
They finally have implemented some stimulus. Their stock market went hyperbolic, because finally you had the government, which has not stepped in, and their M2, their currency, was contracting significantly over the last couple of years. It is finally now in an expansionary territory, and so we saw their stock market really react to that. And I think that American manufacturers have gone and retailers have gone shopping in China, or American retailers have gone shopping in China for significant price concessions to basically deliver these goods. By the way, have you seen something? We're starting to see companies de-inflate products, like the shrinkflation factor. I think it was one of the chip, maybe it's Tostitos or something, that you're going to add more chips to the bag. So now versus having 10 chips, you get 11 or something.
Right. Yeah, no, they're reversing a little bit of the trend.
The shrinkflation is now expansion. Because they realize there's a point, they don't want to they don't want to lower the prices.
Right.
Because now they've reached
once you get rate increases, you don't want to go back.
No, and so the better thing for their standpoint is to increase the quantity, because the cost to do that is relatively insignificant.
Right. Well, I mean, I think the interesting thing here is, okay, so we get into this election cycle. The last time Trump wins, do you think we see something similar to what we saw when the first time he came into office, where basically we got this big stimulus to the economy because of the tax?
Absolutely. I think if you sort of look at, first of all, we're not a political commentator, but if you look at the recent polls, there's the potential of a full sweep of Congress, both the Senate and the House go Republican, and then you have Donald Trump as a president. You're going to see significant momentum for tax policy. Tax is always the easy thing to do, or it's the first thing that government tends to focus on.
Sure.
Donald Trump did that the first thing he did when he got into office.
I mean, it took a good year before that really
Well,
kind of got
17,
flushed out.
if you recall, when he was inaugurated in January of 17, it wasn't until August or September of that year. In fact, we had articles. It was combination of Harvey
and the stimulus.
and the stimulus that hit. And then he started ratcheting up the tariffs conversation in sort of the fall of 17. I think we'll see, like, whether you like it or not, Donald Trump is a much more seasoned, and the people around him will be more seasoned this time around, for better or worse, this time into office, because they actually know the playbook.
Right.
And they've had 4 years to plan, their revenge, if you will, on all the policies that they want to do. And I think they'll hit the ground running with tariff. They will escalate tariffs, absolutely. And I think they'll do a lot of things to stimulate really quickly.
So let's play the other side of the equation. What happens if?
I think policy probably doesn't change a lot. I mean, Harris has said publicly that she largely believes in many of the policies of the Biden administration. She was a part of the administration. But if you look at the stuff that she's published on her website about policy changes, there aren't major sweeping changes.
Right.
Now, there has been more incentives. If you look at Biden's policies and you look at the Democrat policies of this administration as well as in Trump's administration, a lot of the benefits were it's like home benefits. So in the Republican side, a lot of that goes to business owners, middle class. A lot of folks on the Democrat side, I want to bring up folks from the bottom. So it looks at how you stimulate,
right,
which one you're stimulating. So the issue that I think Harris administration has is that they're unlikely to have both houses of Congress, and so it's going to be a lot more sort of gridlock, I think, will be the issue.
Yeah. So do you think that this is going to be just more of the same if Harris?
I think so, and I think it's going to continue to be a challenging market because there's not going to be
even if the House and Senate.
If you saw a blue sweep, I think that would be a complete change. But I don't think anyone's betting for that. If there's a blue sweep, obviously you get a lot of momentum in a different direction, perhaps. But it won't be tax policy stimulus, and I don't think you'll see aggressive tariffs. And I think people will not. I think businesses, regardless of the election, will be glad when it's all over with, as long as it's not contested. Like, if it's not contested, then I think, and there's a clear winner and everyone, we hope, accepts the winner, then I think businesses and consumers will feel a little bit more confident. I think if Donald Trump gets elected and there is a sweep of the houses of Congress, then I think you'll see a pretty significant acceleration in freight demand, because the types of policies that the Republicans tend to focus on, and they've stated publicly, are net stimulus in terms of domestic trucking demand. Right. That's just, if you're talking about raising tariffs, you're pre-running these tariffs in to bring imports.
Right.
That is going to continue. You're thinking about, I need to add warehouse space to store goods that I need for supplies. I need to think about reshoring manufacturing. I need to think about— Is
that with either one?
Well, absolutely. The direction's there.
Okay.
But I think the speed of change.
Okay.
Like, if you look at the Biden administration, it has been a little bit slower the changes haven't been as rapid as what you would see, I think, with a Trump administration that's prepared.
Right. So I think that reshoring topic here, obviously that's going to have a big, depending on the direction of the election, we're going to start talking about Mexico a little bit more. So what are your thoughts around imports, or the shifting of trade from Asia into Mexico?
It's already happening.
Okay.
Now, the thing that's interesting in the tariff and Donald Trump's public speaking and his policy advisors is they've been very, very, and they are actually talking about changing U.S. I hate this name, by the way. Can I call it NAFTA 2.0?
You can do whatever you want.
It's UNSCA, U.S.-Mexico Canada trade policy. It's the worst name.
Right.
If they do anything, can they change the name so it's easier for us to say it?
There you go.
But he's been public about that he wants to renegotiate that agreement because he feels like Chinese manufacturers in Mexico is taking advantage of U.S.
They absolutely are.
And they're moving in production the same way we saw with China to Vietnam.
Yeah.
Is they're moving in production they're moving in goods. They're not even moving production in some cases. They are moving production in some cases, but they're bringing goods in from China into Mexico and just zone skipping or border skipping to look like they're Mexican imports when they're actually Chinese imports. They're effectively repackaged.
Well, we have data that actually supports this. If we pull up the IOTI from China to Mexico, so the data you were just looking at a few minutes ago, this is just the country-to-country bookings for 20-foot equivalent containers going from China to Mexico over the last 2 years. The growth here, 117% since October of 2022 on containerized goods going from China to Mexico. This is not as many raw materials. This is just straight goods.
It's goods that have been produced. And you know what's crazy about this? Is add that number, add the delta on that number to your U.S. import number, IOTI to U.S. Think about how much more imports we've had from China. Like how many more products are flowing in from overseas. I think it's a tremendous story. It's one that, frankly, a couple of years ago we got wrong because, again, global trade, it felt like we were deglobalizing. It's not happening to the degree you would expect, but I think reindustrialization's here. I think it's real. It takes a while to do that. These are some raw materials, but to your point, a lot of these are finished goods. You also have the Shein and Temu exceptions, which are that $600, I think it's $600, $800. You don't have to pay essentially. Like there's a cap on what you can bring in. You're sort of not subject to the quotas and tariffs. And I think what you're seeing is that that loophole is going to be removed because U.S. retailers are going to demand it.
Do you think this is going to significantly alter the supply chain? The natural flow of freight has been Asia, West Coast, East Coast. Is this going to alter that to an extent?
Only in the last 20 years, or 30 years.
Sure, yeah.
Like if you go back, I mean, in the 1980s, China was an insignificant exporter. They essentially, recapitalized. Dean came in I think it was 1978 or 1980, and opened up to the world and created sort of this capitalism with communist characteristics, or Chinese, whatever the state was, like one state, two systems kind of thing around. We'll have some form of capitalism, but it's sort of state-sponsored capitalism. That really took place in the 80s. It wasn't until the mid-90s before you saw any real significant volumes. And it wasn't really until China entered the WTO before you saw a massive change in freight demand. And I think what we're seeing is with that massive change of freight demand is we are now seeing a new generation. It's hard for us to see it in real time.
Right.
But absolutely, I think we're going to see the Americas play a much bigger role in trade and production than we've seen in decades.
Yeah, so kind of pulling that back together with the freight market trend here, J.B. Hunt just came out with their earnings. And, we kind of use J.B. Hunt. They're the first ones to come and tell us what's going on, but they're not necessarily a trucking company, but they represent almost all aspects of the domestic freight market. They're mostly intermodal, dedicated, brokerage, then they have some final mile and truckload.
Half the revenue approximately is railroad.
So intermodal has been a growth function for domestic freight over the last year. We have seen, because of the natural flow of freight coming in from Asia to the West Coast, we had a little bit of turbulence here in the summer because peak season came early for imports. And then we've had this volume shift, this modal shift. Intermodal has taken share. We talked about it last time. Do you think that we see some sort of fundamental altering of the supply chain? Does the rail intermodal now shift to the south?
Yeah, I think the whole Kansas City, remember hottest girl at the prom, and both the railroads, the Canadian railroads, really wanted that. They wanted that because they see something in the value of that north-south direction of freight. And it's interesting if you go back to the 90s, when NAFTA there was this emerging Mexico manufacturing happen even before NAFTA happened in the 80s and 90s, where Mexico was starting to pick up a significant amount of share as we started to globalize, right, the economy. And I think what you saw is is that the north-south trade became far less lucrative than the the Asia to the United States, the west to east trade,
Right.
if you will, or the east to west, I guess if you're talking, from from Asia to the United States. The reality is, I think the north-south trade becomes far more lucrative.
Do you think that hurts or helps trucking?
Oh, it helps it.
Yeah.
Absolutely.
Okay.
This is where we should be excited.
Okay.
So we've talked about a lot of stuff. Let's talk about why we should be happy.
Okay.
So if you think about as trucking operators, we want as much of that freight moving through domestic and through surface freight lanes as possible. Because one of the things that I don't think is factored in, and a lot of people haven't thought about, is when China entered the WTO in 2001, and I remember I was working in the freight market in those days. It might have been 2003, actually. I think it was like a trial period, and then it was a full effect in like 2003. But I remember sitting there and talking to a Wall Street analyst that worked at one of the firms on Wall Street, and they weren't tracking China's entrance into the WTO. And at the time, I made the argument, I was wrong, that this would promote long-haul trucking, because the thought was that you would move your containers into Southern California, you would decontainerize the freight, and then you'd put them into a 53-foot trailer, and that team transit would become really important. That isn't what happened.
Right.
We have the benefit of history to know that what actually took place was when China entered the WTO. So we saw the container flows move into the West Coast. They built these. A lot of those containers ended up on rail, intermodal. That was one thing. They also ended up in these pick and pack sorting centers where they would go in and they would break the trailer, break the container, and they would sort it out through, and then it would end up on some intermodal, but also in some trucking. But the amount of volume wasn't what we expected it to be, and so the benefit was. Two things happened that drove the change in the long-haul market. One was the proliferation of brokerage and small fleets, and the other one was intermodal playing a much bigger role. I mean, intermodal was an insignificant mode of traffic. I mean, you worked in trucking in those days. Remember how offensive if you told a shipper that the freight was on the rail?
Yeah.
Like you had to almost lie about it because you didn't want them finding out that it was on the rail.
It's going to get there.
And you would argue the transit times are the same.
Yeah.
And that market share significantly destroyed the over-the-road trucking long-haul market.
Well, because it takes 4 days to get from Los Angeles to Chicago on a truck.
Yeah, but think about who benefited. I mean, J.B. Hunt's intermodal business really benefited from containers coming in, being broken at distribution centers, and being shipped out on domestic intermodal. But you also had the international intermodal, where the freight wasn't even touched coming off the boat, coming off the ships in Southern California. It was going all the way to Chicago or Memphis or whatever. That, I think, gets significantly impacted. So if I'm going to bet, I'm betting on north-south. Okay. And this sort of feels like a reversal and back to the 90s. I mean, back to the 90s, CFI and Celadon were some of the most profitable trucking companies. So what was interesting about long haul was you had the west and east I-40, I-20 trucking companies that were sort of the leaders. You had Covenant, US Express, and CRST owned, and Transport America to a degree, owned that long-haul market on those lanes. And then you had I'm talking long haul. Right. And then you had the north-south carriers, which were Celadon and CFI. They owned that market. Right. You couldn't compete against them. And what happened is when China entered the WTO, it completely destroyed NAFTA's momentum. I remember being at Baylor, which is in Waco, Texas, in 1997 to 2001. NAFTA was just coming into effect, and it was all the rage in all of our classes because everyone was convinced that NAFTA was going to change the Texas economy and was going to change that whole north-south trade. And we're all told that all of our business would be in Mexico. That isn't what happened. Is China took all of that opportunity when it entered the WTO, and now we're seeing a reversal of that fortune. But freight finds a place. This is the thing that I think you have to be excited about. So everyone argues that the tariffs are going to destroy the economy. And I say it can be impactful for the economy, but the thing about supply chains that is true today that wasn't true back in the 1929s is when you put these draconian tariffs, what were actually was the raw materials that we were impacting and manufacturing goods in the 20s. We didn't have an enormous, the thing that happens in modern supply chains is they can move sourcing much faster than we could in the 1920s.
Right.
And so freight will find a way. Manufacturing and supply will find a way. So you put a 60% tariff, yes, it's impactful. Yes, it has a significant impact. But given enough time, supply chains will find a way. Like it's not a
Goods will be produced, and
goods
they will
be
move.
produced. They'll be manufacturing. It is painful. I'm not going to dismiss this.
Right.
Is a lot of these supply chains are interconnected. We know that, but they will find a way. And when they find a way, they will move to parts of the world where they aren't being impacted by tariffs or geopolitical pressures. And if you're a supply chain executive and you're thinking about where to bet, you're betting on India just because it's the largest population in the way. It doesn't have a communist dictator at the top.
Right.
Like
It's still halfway around the world.
it is halfway around the world, and you have geopolitical risks
Right.
that you have to factor in. I mean, the problem with India is where it's located. If you head west, you're heading right into a conflict zone that's at war. If you head east, you're exposing yourself to a potential conflict zone. But the Americas, if you sort of go back to the Teddy Roosevelt days, man, we're back to the basics of we run this sphere. Like this is our pool, right?
Right.
This is our backyard, and no one's going to mess with us here. And so they could try, but that's the great thing about sourcing is that you don't have to deal with the cross world trade.
So we need to flash up at least the intermodal volume growth for those in the audience that aren't necessarily familiar with this. This growth rate in intermodal since 2022 is phenomenal. You're looking at international and domestic. Domestic, of course, the thing that JB Hunt largely moves. 10% growth over 2 years. Then the international containers, which are half the size in general, or they could be 40s, also growing significantly. This has been a big relief valve for the domestic trucking market. We talk about trucks being too available. There's too much capacity. This is also capacity that is relieving pressure on the market.
During COVID, the railroads were so messed up.
Yep.
They couldn't get chassis in the right place at the right time. It was an utter mess. That isn't the case now.
Right.
And I think this is why rail intermodal is working. Well, it didn't work back then.
Right.
And that's actually provided an enormous relief valve for international imports. But here's the point. There is a finite amount of capacity on the rail. And
lanes.
And we're going to run out of that soon at some point. Like increment, they're going to add capacity, but they're going to run out. And as they run out of capacity, then that's when the demand starts to show up in that over-the-road market.
Yeah, and we think that there's going to be a little bit more of that demand to come. So I think the audience would also be remiss if we didn't talk to rates at some level. This last chart, before I think we get to some Q&A, the contract versus spot rate, and I'm doing it.
Tell the two worlds, man. Look at contract rates. They're starting to trend up a little bit.
That's the point of this chart right here, is that we are not rates, but they're looking at the wrong chart. The not rates itself. There we go. Contract in white and spot rates in yellowish greenish. There's two takeaways here for me, and I want to see if yours are the same. Contract rates are actually going up over the last 6 months.
They are. I see it.
We're turning, like you just said. Spot rates have been going up.
The bottom. So take a technical analysis.
And this is excluding fuel to an extent too on the spot rates. I should state that.
Okay, but so if you've done any study of technical analysis, you always look for higher lows.
Right.
Like look at the way that chart. So higher highs, higher lows. We're seeing the chart bounce up and down. We're seeing a progression. If you drew a line, Zach, and maybe next time you can do it, is draw a line to that progress right through the middle of that. The moving average is going up.
Yep.
Everyone is looking at this and saying this is miserable. And it is. But it doesn't have to be miserable long. What we're seeing is the bottoming process is in. Last May was the low. We're seeing the spot rates still in miserable territory. They're probably running at losses.
Yep.
But we're seeing the loss of capacity. Contracts tell us we're about to make the turn.
Yep.
Like you've seen, again, looking at a chart technically, you're seeing the inflection point. You're seeing that cup come up. This is beautiful. This is art right here. And that's why we should be excited. We have so much to be. Yes, give it up. Yes, thank you. Our audience loves this. They're excited for a recovery in the market. So are we.
Yeah.
Like, so should people be. I'm telling you, 2025 is going to be a great year. And I'm going to explain why. You have tax policy. If we see the election, again, it has to be absolute. You have to have, I think, to have the best outcome in terms of freight, and again, I'm only looking at this in terms of freight, is if we see a Republican win and they have all aspects of the government, all branches of the government, of Congress and the White House, I think what you'll see is significant tax policy changes, and that will in capital equipment, that will end up in consumer taxes changes, and then I think you see a tariff regime change, or significant tariffs. That will drive demand. Regardless of how those policies impact the long-term health of the economy. Like printing money is good for freight, unfortunately. Like whether you like it or not, whether you think it's fiscally responsible and good for our children, it's short-term. When you stimulate the economy, American consumers go purchase goods. American businesses go purchase goods. And if they become bullish about the money that's flowing into the economy, their confidence will increase and we'll see an expansion and we'll see this show up in the goods economy.
I think it's fascinating because technically demand isn't bumping up into supply yet we're already seeing contract rates turn.
That's because the sentiment is changing. People are looking at the cycle. This is I think the Triumph quote that came out and was one of the best, is that this is the longest freight recession since deregulation.
Right.
Put that in perspective. That is worse than the 2008 great financial crisis.
2009.
And what we're looking at here is this really long freight recession. We're at the bottom of the cycle. You can see it in contract rates. And again, look at the spot rates.
They've been coming.
You have higher lows and higher highs as you make that cycle, as you come into it. Look at that inflection point that happened there. Normal seasonality. Like J.B. Hunt said it best, normal seasonality. We are seeing the turn, man. And the thing is, like, this isn't hockey stick stuff.
Right.
Yet. It doesn't have to be hockey stick stuff.
Right.
We have to see, and look, we got to talk about capacity real quick before we run out of time.
Okay.
Because everybody wants to talk about demand, but you got to talk about the other side of the equation, which is capacity. Capacity is coming out of the market. There are bankruptcies happening in our market.
There you go.
Like this is absolutely happening. There are companies leaving our industry, and the banks are not lending money for new trucking companies to the degree that they were. There's no government stimulus for SBA loans that are giving out money for small business owners to expand their fleets. Like all of that stuff is over with. So those carriers that are not operating properly are going to leave us. Rest in peace. But we're about to see a great freight market. I believe it, man. Next year, I think it's going to be great. I think if we see a change, I think we see tariffs come into place. And look, at the end of the day, it doesn't matter if 3 years from now we have significant, this creates a draconian impact to the economy. Short term, it is a stimulant. And if you want to get out of the freight recession, you want to move out of this cycle, you need something to stimulate it.
Right.
Something big. And there's nothing bigger than the American government to do that job for us.
So you think 2025 we've got?
I tell you, man, I'm getting bullish.
Bullish. Trump or Harris?
I think you needed a change in administration to actually get bullish.
Okay.
At the end of the day, I think we need something to stimulate our economy and our freight economy. Right. We need good stimulation, and I think tariffs will create. We've seen it in every cycle. Tariffs will force companies to think about their supply chains, both short-term and longer-term, prioritize the Americas in ways that they haven't prioritized in the past. Because tariffs are stuck. The idea of globalization, of this free markets everywhere, has not worked to the degree we were all told it would. Like, they actually haven't been free. Like, you can't export, if you think about this, all these other countries, like, they penalize American businesses. They put tariffs on automobiles. You can't sell hardly anything in China.
Right.
Like it's a closed market, but we let them dump products on us.
Yeah.
And that is, the American consumer is not going to stand for.
You can't
Even
sell...
the Republicans, which has been
yeah.
really promoting free trade, have become the populist party that has actually become sort of nationalistic and trade policy.
Right.
That is...
They're implementing the trade policies that other countries treat us with.
That's the view.
Yeah.
That's the view.
Yeah.
And I think what we're seeing is a reversal of all of the, and this stuff goes through cycles throughout history, we're seeing a reversal of that. And I think what we're seeing is that the idea of free trade is not going to happen. So every supply chain professional has got to be calculating that.
Yeah.
So you should be bullish on trucking. You should be bullish on rail. Surface is going to win. This is our decade.
What about the air?
I like air too.
Okay.
Air deals with volatility, but like I like surface. Yeah. I'm bullish on rail and bullish on trucking. I'm bullish on warehousing as well. All right. Because you got to have a place to store all this stuff.
Well, let's get to some Q&A before we run out of time here. So I'll pass it over to Julia because I bet we got plenty.
Awesome. Yeah. Thanks, Zach. So I'm going to go through a couple of questions. A bunch of you have already submitted wonderful questions. Just know that we'll go through as many as we have time for. Feel free to enter them at any point. So this first question is from Tyler. He asks, I'm interested to hear your perspective on the movement within the LTL market and why LTL isn't seeing the trickle of these imports going to warehouses, distributors, and consumers.
I'll take this one. So LTL, of course, is in sort of a disconnect. Normally we see trucking and LTL really move. Truckload and LTL move in a very similar pattern. Whether that looks true or not in the public earnings is another story that requires a longer explanation. But LTL, of course, has been going through a process of dealing with Yellow's exodus. And that has created a little bit of a disconnect. So yep, LTL had a bit of a bubble last year in terms of things got a little bit more tight. And LTL markets are more industrial than they are retail. So we've got two things going on. You've got they're not as exposed to the import situation naturally, but you've also had this, they're kind of clearing out this Yellow situation. So they're not having to take on that lighter retail freight either.
That's a great point.
Yeah.
75% of containers is retail goods, produced, manufactured retail goods. LTL doesn't move as much of that through its system as truckload does. And remember, we've talked about this before, is the importers that are bringing freight in, what's driving the predominance of the IOTI data and what's driving the predominance of that container flow are big box retailers with mature logistics network.
Yep.
They're putting this into their dedicated fleets and their private fleets, into their warehouses, into their existing logistics network, and they're moving it in high volumes. These aren't a lot of small companies. They don't have the balance sheet to go basically fill out, you purchase all these products in pre-plan. These are big companies that are actually bringing products in. And that's why we don't see the LTL, because LTL by definition is smaller shipment size.
Yeah, exactly. All right.
Awesome. Next question here. A bunch of folks have been asking about the remaining number of carriers in the market. So do you have a number as to how many motor carriers have left the market in 2024 and an estimate to the number that would represent being brought back to an equilibrium?
Well, the carrier details data would suggest about 20 to 25,000 carriers left. That data is very lagged. I have trouble stating that as a definitive because it takes 2 years to get revoked if you do nothing. Then there's the ones that you're kind of relying on self-reporting. That's not a great figure either. So, but it's in the 20 to 25,000 range in terms of definition. There's probably more that have already left. Like in terms of
I think one of the things to keep in mind here, it's lagging data. The second thing is you wrote an article back in 2021 as the sort of the freight risk, or 2022 at the sort of like I think it was November of 22 or something, about how long it would take. By the way, you're right on that. Good job.
Yeah.
Like,
Did some
you got a
basic math.
lot of heat on this. It was the idea that we had 28% more capacity in the market than we had pre-COVID.
Right.
And people are like, oh, that can't be the case. Well, that explains how this has been such a miserable cycle. And it's funny because you actually projected that we would lose a lot of those excesses if the trend line continued using some data science by the end of the first quarter, the start of the second quarter. It was like March, April of 2025. That's proven to be correct. That excess is getting bled off.
Yeah.
And as the excess gets bled off, it will continue to get bled off because this market capacity follows the cycle. Capacity resets. Celadon went bankrupt in December of 2019. The market was already recovered. Like if you go to OTVI in 19, you can actually see the inflection point. You can see OTRI picked up in November of 2019 is when we saw the inflection point. We were bullish headed into 2020. Celadon, one of the largest truckload carriers to ever fail, happened at the end of that year. And we still saw capacity leaving the market. We will still see that past the reset point. But the reset is in. Demand's going to be driven. It's going to be beautiful. 25, man. It's my magic
25.
number.
There it is. Spring of 25. The return of freight.
On those same lines, do you think we'll see a weak Q4 given the pull forward in Q3 with early peak season?
I think the comps are going to be so much easier. It depends what you mean week. I think the holiday peak season will actually be pretty decent. I think it's going to stay steady. I don't see, you've had the Fed. We haven't even talked about the Federal Reserve.
Oh, I know, right?
Like they're the most important factor in all of this. We've gone the whole day without mentioning the Fed.
And ever since they cut rates, we've only had positive economic indicators.
We've had positive economic indicators. We saw a 50 basis point cut. You know, it's interesting looking at SOFR. SOFR is like how most floating debt's set these days. It used to be LIBOR, it's now SOFR. It's only dropped by 10 to 15 basis points. It hasn't really factored in. The 10-year actually is gonna. Anyways, I don't want to get into monetary conversation too deep, but the Fed is at least orientated to cut. At least that's what they've said. We've seen better economic data, and some of the data points has been slightly better than anticipated, or slightly higher inflation than anticipated. I think, and the next Fed meeting is right after the election. So it's going to be interesting to see what the Fed does. But that's also, if they maintain a stimulus orientation and they look like they're going to cut rates, I think that's another demand driver. Again, a reason to be bullish.
I think Craig's bullish.
Tell me why we should be bearish right now. Give me the bearish case.
There's still too many trucks.
Okay, but look at your data right here. Are we not losing them?
We are, but there's not enough.
You think it's
falling
slowly?
out.
Okay, but are things going to get progressively better? Give me a bearish case.
So reason they would not get progressively better is that we continue on the path of slow exodus. Banks continue to hold on to bad assets, continue to support people having their trucks longer than they need to. And it creates a softer transition.
But is it going to get worse?
No, it can't.
Unless there's an economic
There's
fall.
got to be something else that's unforeseen.
What do you guys think? Bullish or bearish? Bullish. We're all bullish in this room, except for you.
Awesome. I've got
pushed me into
time
the
for one more question, and then we'll wrap up. Is there any indication that shippers are bringing forward inventory with the potential change in administration and the impact of higher tariffs?
Absolutely.
100%.
I've talked to numerous importers. Talked to a guy that's in industrial, bringing in steel. He goes, we're bringing in every piece of steel that we can get our hands on. Steel tariffs have been a favorite of every administration.
Yeah.
Like if you go back to even the Reagan administration, that was, whether Reagan or Clinton or Bush 1, Bush 2, steel tariffs have always been in play. It's just been a favorite tariff. But he said he's sourcing every piece of steel he can get his hands on because of the threat of these tariffs. So absolutely manufacturers are bringing in raw materials in advance of it. Retailers are bringing in some items they think are going to be subject to it. Absolutely, that's happening. Now, is that all of the answer? I don't think so. I think there's other things driving it. We have time for one more. Come on, Julia, give us another one.
All right, we'll take one more. What is there to stop the banks from dumping more money into the freight world as soon as they see the market turn again?
The banks aren't that quick. So that's the reality. Have you ever dealt with a bank? You dealt with a bank?
Yeah.
Have you had you worked at a bank?
Yes.
You know how this is.
Yeah.
Bankers are slow. They react, they go in and out of like theses. Mm-hmm. So the reason that we allowed the expansionary cycle to go on so long was because it took them a year after the market had turned to realize things were bad. They were still in a pretty, like looking at trucking being a good market well into 23. It will take them, and when they go risk off and they start to actually look at it, and also the FDIC, there was a bank that actually fell because of trucking. The FDIC came in and said, you have too much concentration risk in trucking, and basically they looked at their balance sheet and made them write those assets down and took over the bank because it was effectively bankrupt. The regulators and the bankers believe that trucking is a bad industry right now. It's not an investable industry or an industry that needs capital. And I've talked to multiple people who tell me that they went out for loans and couldn't get them. I had one guy that actually accosted me because he was a trucker trying to expand his fleet. And he goes, the banker read FreightWaves and realized how bad the market was. I'm like, sorry, dog, like, it's not my fault. Like, we do what we do, and I saved you from like much more painful conversation. But banks aren't going to lend short term, and that's why the cycle is so lagged.
Yeah.
When the banks loosen up, that's when it's different, but they will take a while before they do it. They have other things that they want to do, and trucking is a risk-off environment right now.
Yeah, the reason we have the bubble that we have and we're still dealing with is because once the market peaked, banks then realized this is an investable place.
They also were
and they jumped into the market.
They did, and they had the SBA loans. We don't have those. Yeah. I wouldn't worry that as a factor. I think 25 is going to be a good year.
It'll take them a full year to figure out if the market turns anyway, like you said.
Awesome. What a great, lively conversation today. That's all the time that we do have for today. Craig and Zach, as always, thank you guys for being here with us. Our live studio audience, we loved having you in today. And also thank you to you, our audience online, who always is participating and asking so many great questions every month. Just a reminder, our State of Freight webinar series is going to continue again next month at F3, the Future of Freight Festival, right here in Chattanooga, Tennessee. It takes place November 19th through 21st. We'll be hosting that event in person with, again, another live studio audience. You'll be able to ask your questions of Craig and Zach live. We hope to see you at that event. Get your tickets at live.freightwaves.com. That's all for today. Thanks for joining us.